The greatest deception in the financial world is not the crash itself, but the calm that comes before it. Human beings have a strange tendency to mistake silence for safety, to confuse temporary stability with permanent security. This is the first and most dangerous illusion. Every time history has delivered a devastating financial collapse, the months or years leading up to it have been filled with optimism, reassurances, and glowing headlines about growth. But the silence is never real. It is the muffled sound of cracks forming beneath the surface. The calm before the storm is not peace. It is the tightening of the rope. Think of how markets behave when everything seems fine. Stock charts rise slowly and steadily. Television anchors speak with bright smiles about new highs in the market. Politicians talk of resilience and progress. Investors, driven by the constant rhythm of gains, forget what loss even feels like. The collective memory of pain fades. Greed reemerges, dressed as confidence. People stop asking questions. They start believing that this time is different, that the cycle of boom and bust has been broken by innovation, by technology, or by better management of risk. The irony is cruel because it is exactly when people are convinced that there is nothing to fear that they should be most afraid. Behind the curtain of stability lies a story nobody wants to acknowledge. Debt is piling up like dry wood in a forest. Corporations borrow aggressively to expand. Individuals take on loans for houses and cars. Governments print money to cover deficits. And central banks keep interest rates low to maintain the illusion of prosperity. This expansion is not real wealth. It is borrowed time. Every number that looks impressive on the surface hides a shadow, a future obligation that must eventually be paid. But since the payments are not due today, the system convinces itself that tomorrow will take care of itself. The calm before the storm is built on tomorrow's promises, and tomorrow always arrives. This calm is deceptive because it is designed. Central banks, regulators, and financial institutions know that fear spreads faster than facts. To maintain confidence, they must project stability. They announce programs to inject liquidity into markets. They reduce interest rates to encourage spending. They tell the public that growth remains strong, that inflation is temporary, that risks are under control. These statements are not lies in the ordinary sense. They are half-truths carefully delivered to maintain calm long enough to keep the system running. And it works. Investors nod their heads, citizens keep depositing their paychecks, and businesses continue to borrow. But the calm is artificial. It is the quiet hum of a machine that is overheating. One of the most dangerous aspects of this calm is how it changes behavior. When the world feels safe, people take more risks. Investors stretch for higher returns, buying assets they don't fully understand. Home buyers sign mortgages they cannot afford. Entrepreneurs raise capital at valuations detached from reality. Every action makes sense in the moment because everyone else is doing the same thing. Herd mentality is powerful, and in the financial world it is deadly. The calm before the storm is not only the result of hidden cracks in the system, it is actively worsened by the reckless decisions people make when they believe the system is unbreakable. History provides countless examples of this illusion. Before the Great Depression in 1929, headlines were filled with stories of prosperity. New York was booming, credit was flowing, and the stock market was breaking records. Nobody wanted to hear about weaknesses, and those who warned of danger were dismissed as pessimists. Before the 2008 global financial crisis, Real estate prices in America seemed unstoppable. Banks packaged mortgages into complex securities. Investors around the world rushed to buy them, and ratings agencies stamped them with labels of safety. It was only after the calm shattered that the truth became clear, that the system had been a house of cards all along. The calm before the storm is seductive because it appeals to our deepest desires. Everyone wants to believe that prosperity can last forever, that progress is permanent, that we have outgrown the mistakes of the past. This belief makes us blind to warning signs. Rising debt levels are ignored because this time is different. Asset bubbles are justified by new technologies or changing demographics. Political instability is dismissed as temporary noise, but history is merciless to those who ignore its lessons. The calm is not a gift, it is a trap. Another reason this calm is so dangerous is that it feeds on itself. When markets rise, people feel wealthier. When they feel wealthier, they spend more. When they spend more, businesses earn more. When businesses earn more, stock prices rise further. This feedback loop creates the illusion of infinite growth, and as long as the cycle continues, nobody wants to stop it. The calm grows louder, drowning out dissenting voices. But this cycle cannot continue forever. At some point, the system reaches a level of debt, speculation, or imbalance that is unsustainable. And when the loop finally breaks, the collapse comes not gradually, but violently. It is also important to understand that this calm is not evenly distributed. Some see the cracks earlier than others. Wealthy investors, hedge funds, and insiders often spot the signals before the public does. They quietly begin moving money into safer assets, hedging their bets, or exiting risky positions. Meanwhile, ordinary citizens, trusting in the reassurances of authorities, continue to invest, continue to borrow, and continue to build their lives on the assumption of stability. By the time the storm breaks, the insiders are already protected, and it is the masses who face the devastation. This is why financial crashes feel so unfair, because they are. Technology adds a new dimension to this calm. In the digital age, information flows faster than ever, but so does misinformation. Financial markets are influenced not only by official reports, but also by viral rumors, trending narratives, and algorithm-driven news feeds. The calm before the storm today is not only manufactured by central banks, it is reinforced by the echo chambers of social media and digital platforms. A false sense of security spreads globally in seconds, making the eventual crash even more shocking when reality finally pierces the illusion. The calm before the storm is not a period of safety. It is the final phase of denial. It is the moment when individuals, corporations, and governments convince themselves that the risks they have taken will never come due. It is the stage where optimism becomes arrogance, where prudence is mocked, and where warnings are ignored. The silence is not the absence of danger. It is the accumulation of hidden danger waiting for a trigger. The longer the calm lasts, the more destructive the storm will be when it arrives. Financial collapses are rarely the result of a single dramatic event. The world likes to imagine that history changes with one headline, one breaking news alert, one shocking announcement that shifts everything overnight. But in reality, collapses are built slowly, piece by piece, through years of fragile decisions, risky bets, and systemic vulnerabilities that accumulate beneath the surface. The crash is not born in the moment when the market falls. It is born in the hidden places where small imbalances grow unchecked. These are the hidden triggers, the quiet forces that build the foundation of disaster. And in 2025, they are more dangerous than ever. The first hidden trigger lies in the over-leveraged corporate world. Companies around the globe, intoxicated by the era of cheap money, have borrowed at levels never seen before. For years, interest rates were kept low, encouraging businesses to expand, acquire, and grow without discipline. The logic was simple. If debt is cheap, why not borrow more? But the consequence is that corporations are now sitting on mountains of liabilities that depend on the assumption of perpetual stability. When revenues fall even slightly, when borrowing costs rise, or when consumer demand shifts unexpectedly, these debts become impossible to sustain. Defaults begin not at the largest firms, but in the smaller and mid-sized companies that form the backbone of the economy. These failures may look isolated at first, but they ripple through supply chains, through credit markets, through investor confidence. The hidden trigger is not a single corporate collapse, but the domino effect that begins when one company's failure undermines another's. Alongside corporate debt, the second trigger comes from shadow banking. While traditional banks are subject to regulations, stress tests, and capital requirements, shadow banking operates in the murky space outside of those rules. Hedge funds, private lenders, and alternative financing platforms have grown into massive players, moving trillions of dollars through opaque channels. On the surface, they provide flexibility and innovation, but beneath that surface lies fragility. Shadow banking thrives on leverage, on risky bets that are profitable in good times, but catastrophic in downturns. Because they are less transparent, nobody knows exactly how much exposure exists in this sector. The moment stress hits, liquidity can vanish instantly, freezing the flow of money across industries. What makes shadow banking a hidden trigger is not its visibility, but its invisibility. Markets cannot prepare for risks they cannot measure. The third trigger comes from speculative bubbles in technology. Over the last decade, investors have poured unprecedented amounts of capital into artificial intelligence, green energy, space exploration, and digital platforms. Some of these innovations are genuine revolutions that will reshape the future. But many companies riding this wave have little more than a vision and a marketing story. Their valuations are detached from reality, inflated by hype and the fear of missing out. In 2025, these bubbles are stretched thin. A single disappointing earnings report, a failed product launch, or a regulatory crackdown could puncture the illusion, sending entire sectors into free fall. History has shown how quickly technology bubbles can burst, from the dot-com crash of 2000 to the crypto collapses of the 2020s. When valuations are built on hope instead of fundamentals, they collapse the moment belief is shaken. Geopolitical tensions form another hidden trigger, one that is rarely factored into economic models until it is too late. The global economy is interconnected, reliant on supply chains that stretch across oceans and political systems. In 2025, rising conflicts over trade routes, energy resources, and technological dominance have created a fragile balance. A blockade in a shipping lane, a cyber attack on critical infrastructure, or a diplomatic breakdown between superpowers can ignite panic in financial markets. These are not traditional economic events, yet they have the power to freeze trade, spike commodity prices, and disrupt the flow of capital. Unlike predictable economic cycles, geopolitical shocks are sudden and uncontainable. They strike at the heart of confidence, which is the most fragile element in finance. Another hidden trigger is energy. The global economy depends on a steady and affordable supply of oil, gas, and increasingly renewable resources. But energy markets are volatile by nature. vulnerable to political manipulation, natural disasters, and technological bottlenecks. In 2025, the transition from fossil fuels to renewable energy is accelerating, but the infrastructure is not yet ready to handle the shift smoothly. Power shortages, blackouts, and supply disruptions are becoming more frequent. If energy costs spike unexpectedly, entire industries face higher expenses, shrinking profits, and reduced output. The knock-on effect hits consumers through higher prices, feeding inflation, which in turn pressures central banks to tighten policy. Energy instability does not cause a crash by itself, but it amplifies every other weakness in the system. The financial system also faces a hidden trigger in the form of liquidity traps. Central banks have been the guardians of stability for decades, stepping in whenever markets wobble. They print money, lower interest rates, and inject liquidity to calm investors. But in 2025, their tools are weaker than before. Interest rates are already low in many parts of the world. Debt levels are already sky high, and public trust in monetary authorities is eroding. When the next crisis comes, central banks may find that their usual remedies have little effect. Worse, attempts to inject liquidity could backfire, fueling inflation and accelerating panic. This limitation is itself a hidden trigger because it means the safety net the world relies on may no longer exist. Consumer debt cannot be ignored as another pressure point. Around the globe, households are stretched thin by mortgages, student loans, credit card balances, and personal lending. In many economies, wages have not kept pace with the rising cost of living. As a result, consumers are living paycheck to paycheck with little margin for shocks. A sudden rise in unemployment, a decline in housing prices, or an increase in interest rates can push millions into default. These individual defaults, when multiplied across millions of households, become systemic. Banks face rising losses, spending collapses, and political anger rises. What looks like a personal financial struggle becomes a national and even global trigger. Social media and digital communication act as accelerators of these hidden triggers. In previous eras, fear spread slowly through newspapers and television broadcasts. Today, panic travels at the speed of a click. A rumor, a viral post, or a leaked document can trigger bank runs and market sell-offs within hours. Algorithms amplify fear, trading bots respond automatically to news, and within minutes, billions of dollars can evaporate from markets. The hidden trigger here is not just the event itself, but the speed at which fear multiplies. What once unfolded over weeks now happens in days, sometimes even minutes. The interconnected nature of global markets ensures that no trigger remains local. An energy crisis in one region drives up prices worldwide. A corporate default in one country undermines banks in another. A currency shock in one market destabilizes emerging economies across continents. In 2025, with digital systems linking every exchange, every payment platform, and every supply chain, the world is a web of interdependence. This interdependence magnifies small problems into global crises. A spark in one corner of the system can ignite fires everywhere else. The final element that makes these triggers so dangerous is the human factor. People believe they will have time to react, that they will see the warning signs and act before it is too late. But hidden triggers work precisely because they are invisible until they erupt. By the time the public notices, the system is already unraveling. Investors will rush to exit markets. Banks will tighten lending. Governments will scramble to reassure citizens. But the damage will already be in motion. Hidden triggers are not just about economics. They are about psychology, about the collective blindness that allows danger to build unnoticed until it is too late. Every financial crash is at its core a crisis of confidence. People often imagine collapses as numbers failing on screens or banks falling one by one. But the true foundation of the financial world is trust. Trust in banks, trust in markets, and above all, trust in money itself. For more than a century, the US dollar has held that trust. It has been the anchor of the global system, the currency in which oil is priced, debts are settled, and trade flows are measured. But in 2025, the foundation of that trust faces unprecedented strain. The role of global currencies is not just a technical detail of finance. It is the bloodstream of the entire world economy. And when that bloodstream is poisoned, collapse is inevitable. The dollar's dominance was never an accident. After the Second World War, the United States emerged with unmatched economic and military power. Agreements like Bretton Woods cemented the dollar as the global reserve, tying it to gold and later to sheer political and economic might. Every nation needed dollars to trade. Every bank needed dollars to settle transactions. Every investor needed dollars to store value. This dominance created a cycle of dependence. Because everyone used dollars, the dollar became even stronger. And because it was strong, everyone continued to use it. For decades, this cycle appeared unbreakable, but cycles do not last forever. And in 2025, the cracks in dollar supremacy are wider than ever before. The first crack comes from debt. The United States has financed its dominance by borrowing endlessly, confident that the world will continue buying its bonds. Trillions of dollars in US government debt sit in the vaults of foreign governments, corporations, and investors. This debt is seen as safe because the dollar has always been seen as safe. But as deficits grow larger, as political battles in Washington grow more chaotic, and as inflation erodes the value of these bonds, trust begins to fade. If even a small fraction of foreign holders decide the dollar is no longer a reliable store of value, they will seek alternatives. That shift does not need to be massive to be devastating. A gradual move away from the dollar by a few major economies could spark a chain reaction, undermining demand for US debt and sending shockwaves through global markets. The second crack lies in the rise of alternatives. China has been working for years to internationalize the yuan, creating trade networks, energy contracts, and digital payment systems that bypass the dollar entirely. Russia, isolated by sanctions, has been forced to build parallel financial systems, linking its trade to currencies other than the dollar. Regional alliances are exploring settlement mechanisms in local currencies, reducing exposure to US dominance. Even private technology giants are experimenting with digital tokens that could serve as alternatives to traditional currencies. Each of these efforts is small on its own, but together they represent a powerful trend. The world is preparing for life beyond the dollar. The third crack comes from technology itself. The rise of central bank digital currencies, CBDCs, is rewriting the rules of finance. Nations from China to Europe are rolling out digital versions of their money, designed to be faster, cheaper, and more controllable than traditional currencies. These systems allow countries to trade directly with one another without routing through the dollar-dominated SWIFT system. If widely adopted, CBDCs could reduce the necessity of the dollar in global trade, accelerating its decline. Once again, the issue is not that the dollar disappears overnight, but that its role gradually weakens until a tipping point is reached. Trust erodes slowly, then all at once. Another dimension of the currency crisis is political weaponization. In recent years, the United States has increasingly used the dollar as a tool of foreign policy, freezing assets, cutting off nations from the financial system and enforcing sanctions with unprecedented reach. While effective in the short term, this has sent a clear message to the rest of the world. Reliance on the dollar means vulnerability to U.S. control. Nations that once saw the dollar as neutral now see it as a lever of power, one that could be turned against them at any moment. This perception fuels efforts to diversify reserves, build alternative systems, and reduce dependence on a currency that can be weaponized. The more the dollar is used as a tool of control, the less it is trusted as a universal standard. Currency crises are particularly dangerous because they hit at the foundation of everything else. When a stock market falls, people still trust their money. When housing crashes, they can still rely on cash to hold value. But when confidence in money itself begins to waver, there is no safe ground left. Inflation becomes harder to control, trade becomes unstable, and wealth can vanish overnight through currency devaluation. In 2025, with multiple powers challenging the dollar, the potential for such a crisis is greater than it has been in generations. The ripple effects of a currency shift are enormous. If oil producers begin accepting payment in yuan or digital currencies instead of dollars, global demand for the dollar shrinks instantly. If central banks reduce their holdings of U.S. treasuries, interest rates spike, making it harder for America to finance its debt. If multinational corporations begin settling accounts in non-dollar currencies, liquidity in dollar markets dries up. Each of these shifts undermines not only the dollar, but also the countless systems built around it. Banks, corporations, and even governments that depend on dollar flows suddenly find themselves exposed to risks they never planned for. The psychological dimension of currency dominance is perhaps the most powerful trigger. Investors and nations continue to hold dollars not only because they must, but because they believe everyone else will. This is the self-reinforcing cycle of confidence. But if belief in the dollar falters, if people begin to suspect that others are losing faith, the exit becomes a stampede. Currency collapses rarely happen slowly. They happen when the crowd decides all at once that the trust is gone. In the age of digital finance, where billions can be moved in seconds, this stampede can unfold faster than any central bank or government can react. Emerging markets are particularly vulnerable to this shift. Many nations borrow heavily in dollars, meaning their debts must be repaid in a currency they do not control. If the dollar weakens, the cost of borrowing skyrockets. If it strengthens too much, their economies collapse under the weight of repayment. Either way, dependence on the dollar creates instability. As these nations seek alternatives, they contribute to the erosion of dollar supremacy, setting in motion the very crisis they fear. The collapse of a dominant currency does not just shake markets, it rewrites history. When the British pound lost its global role in the mid-20th century, it marked the end of Britain's empire and the rise of American power. A similar shift in 2025 would mark not just an economic change, but a geopolitical one, signaling the decline of U.S. influence and the emergence of a multipolar financial order. Such transitions are never smooth. They come with shocks, imbalances, and crises as the world struggles to adjust to new rules. The role of global currencies in a financial crash cannot be overstated. Money is the oxygen of the system. If people lose confidence in its stability, the system suffocates. The dollar has long been the oxygen tank for the world, but cracks in its reliability are spreading. In 2025, with debt soaring, alternatives rising, and trust eroding, the stage is set for the unthinkable, a moment when the world decides that the dollar is no longer the foundation it once was. And in that moment, the financial storm that has been building for years will find its ignition point. Debt has always been both the engine of growth and the seed of destruction in the global economy. It builds skyscrapers, finances innovation, funds governments, and keeps the wheels of consumption turning. Yet beneath this apparent prosperity lies a dangerous truth. Every dollar borrowed today is a promise to repay tomorrow, and those promises accumulate like fragile blocks stacked in a tower. One block removed, one shock introduced, and the entire tower can collapse. The metaphor of debt as a domino is not poetic exaggeration. It is the most accurate description of how financial crises spread. And in 2025, the dominoes are lined up in ways that make collapse not only possible, but inevitable. The first layer of this domino system is household debt. Across the globe, families are living with obligations that exceed their capacity to repay. Mortgages in overheated housing markets, credit card balances swollen by inflation, student loans that stretch into middle age. All of these debts rest on the assumption of steady employment and rising wages. But wages have not kept pace with the cost of living. When food, energy, and housing costs climb faster than income, families bridge the gap with borrowing. At first, this seems manageable. A new credit card here, a small loan there. But when millions of households are engaged in the same cycle, the numbers swell into something unsustainable. A sudden rise in interest rates or a wave of job losses transforms these manageable debts into crushing burdens. Families default, homes are foreclosed, and consumer spending, the lifeblood of economies, contracts sharply. What begins as individual struggles quickly becomes a national crisis. Above households sit corporations, and their debts dwarf those of individuals. In the era of ultra-low interest rates, companies treated borrowing as the cheapest form of fuel. They borrowed not just to expand operations, but to buy back their own stock, inflating share prices and rewarding executives. Balance sheets bloated with leverage, justified by the logic that growth would always outpace obligations. Yet growth is slowing, competition is rising, and consumer demand is weakening in many sectors. A single drop in revenue can send a heavily leveraged company spiraling. Once one large corporation fails, confidence in entire industries can crumble. Suppliers lose contracts, lenders face defaults, and investors rush to withdraw capital. The domino effect begins with one company, but never ends there. Governments themselves form the third and perhaps most dangerous layer of debt. Nations have borrowed endlessly, financing deficits through bond markets and assuring citizens that growth will cover the costs. United States, Europe, China, and countless others have seen their debt to GDP ratios soar. For decades, investors believed government debt to be the safest asset in existence. But safety is an illusion when obligations outstrip the ability to repay. Rising interest rates mean governments must spend more of their budgets just servicing existing debt, leaving less for infrastructure, healthcare, or defense. Political leaders, unwilling to impose austerity, borrow even more, compounding the problem. If investors lose faith in a government's ability to manage its obligations, yields rise sharply, borrowing becomes unsustainable, and the sovereign debt domino falls. History has shown that when nations default, the ripple effects spread far beyond their borders, undermining global markets. The interconnectedness of these debt layers is what makes the domino metaphor so fitting. Households depend on corporations for jobs. Corporations depend on consumers for revenue. Both depend on governments for stability, infrastructure, and regulation. When one sector falters, pressure shifts to the others. A wave of household defaults reduces corporate earnings. Weakened corporations lay off workers, further damaging household finances. Declining tax revenues and rising bailout costs strain government budgets. The failure of one domino pushes the next, and the collapse spreads faster than most can comprehend. Financial institutions, particularly banks, stand at the center of this system. They lend to households, they finance corporations, and they buy government bonds. Their balance sheets are a reflection of the world's debts. When defaults rise, banks absorb the losses. Their capital shrinks. Their ability to lend diminishes, and credit dries up across the economy. Even a rumor of weakness in one major bank can trigger panic as depositors rush to withdraw funds and counterparties refuse to extend credit. This fear, once ignited, is nearly impossible to contain. The failure of Lehman Brothers in 2008 demonstrated how quickly trust can vanish, turning a contained crisis into a global meltdown. In 2025, with debts at record levels, the risk of a similar or even larger domino collapse is far greater. Emerging markets represent another fragile link in this chain. Many developing countries finance growth through borrowing in foreign currencies, often the US dollar. When their local currencies weaken or when global interest rates rise, repaying these debts becomes impossible. Defaults in one emerging market spook investors in others, leading to capital flight, collapsing currencies, and political instability. These crises rarely remain contained. They spill into global markets, hitting banks, corporations, and governments worldwide. In the domino of debt, emerging markets often fall first, but their collapse accelerates the fall of larger, more systemically important players. One of the most overlooked aspects of the debt domino is the psychological element. As long as people believe debts can be repaid, the system functions. Banks lend, investors buy bonds, consumers borrow, but belief is fragile. If doubts spread, if people begin to question whether debts will be honored, the system unravels quickly. Creditors demand higher interest, borrowers face impossible costs, and defaults multiply. The perception of risk becomes reality. Fear spreads faster than balance sheets can adjust. In modern markets where information and rumors travel instantly, the psychological trigger is more powerful than ever. A single viral story about a major default can set off a chain of panic selling across continents. The scale of debt in 2025 makes the domino effect uniquely dangerous. Global debt has reached levels far exceeding global GDP, a sign that much of the world's apparent wealth is not owned but owed. This imbalance means that even small disruptions can cascade into systemic collapse. A modest rise in interest rates can add hundreds of billions to annual debt servicing costs. A small decline in economic growth can push entire nations into crisis. The dominoes are not evenly spaced. They are stacked precariously close, so that one falling almost guarantees the fall of others. What makes this situation even more precarious is the illusion of control. Policymakers, central bankers, and financial leaders assure the public that debts are manageable, that safety nets exist, that mechanisms are in place to prevent systemic collapse. These reassurances are part of the calm before the storm. But history has shown that once the dominoes begin to fall, control evaporates. Bailouts may save some institutions, but they often come too late to stop the spread of panic. Monetary easing may provide temporary relief, but it cannot erase obligations. Printing money may delay defaults, but it risks inflation that undermines confidence in the currency itself. Each attempt to control the collapse may buy time, but it often worsens the eventual reckoning. The domino of debt is not just a metaphor for markets. It is a reality that defines the modern global economy. Every loan, every bond, every line of credit is a block stacked on another. In good times, the tower rises higher, admired as a symbol of growth and stability. But height brings fragility. The higher the tower, the greater the force when it falls. In 2025, the tower of debt has reached unprecedented heights, its foundation weakened by years of reckless borrowing, its balance threatened by rising interest rates, slowing growth, and eroding confidence. The question is not whether the dominoes will fall, but when and how violently they will topple, dragging households, corporations, banks, and governments into the storm together. At the heart of every financial collapse lies not just numbers, charts, or balance sheets, but human psychology. Systems may appear mechanical, driven by equations and data, yet their foundation rests on trust, perception, and belief. The economy works because billions of people around the world wake up each day convinced that their money will hold value, that their banks will honor withdrawals, that their governments will maintain. When that belief begins to crack, panic emerges, and panic spreads faster than any technical failure. In 2025, the human panic factor is magnified by technology, speed, and the interconnectedness of global finance, making it one of the most volatile and destructive forces in the modern economy. The first dimension of panic is speed. In past financial crises, fear spread gradually through word of mouth, newspapers, or delayed broadcasts. In today's world, panic spreads instantly. Social media platforms, online news feeds, and digital communication ensure that rumors, speculation, and fear circulate in real time. A tweet, a leaked report, or even a misinterpreted headline can trigger mass reactions within minutes. Investors no longer have the luxury of time. Algorithms react in microseconds, selling assets at the first sign of trouble. Ordinary people watching markets collapse live on their phones rush to withdraw money, sell stocks, or hoard cash. Panic today is not a slow burn, but a lightning strike. The second dimension is amplification. When fear takes root, it feeds on itself. One person's decision to withdraw funds from a bank is rational if they fear collapse. But when thousands make the same decision simultaneously, the very act of protecting oneself creates the failure they feared. This self-fulfilling prophecy is the essence of panic. In markets, when investors begin selling, prices drop. Falling prices confirm the fears of others, leading them to sell as well, which drives prices even lower. This feedback loop has no natural stopping point. It continues until confidence is restored or until the system collapses under the weight of mass exits. In 2025, amplification is supercharged by the presence of high-frequency trading, AI-driven investment strategies, and social media virality. Fear is no longer contained within borders or industries. It spreads across markets instantly. The third dimension of panic is the erosion of trust in institutions. Central banks, governments, and major financial institutions have long served as stabilizers, projecting strength and reliability in times of crisis. Yet repeated bailouts, political gridlock, and growing inequality have eroded public confidence. People no longer believe that institutions can or will protect them. When the next crisis begins, reassurances from leaders may not carry the same calming effect they once did. Instead, skepticism will dominate, and citizens may act faster to safeguard themselves. This erosion of trust transforms what might have been a manageable disruption into a full-blown panic. The psychology of crowds plays a crucial role in this process. Individuals may act rationally on their own, weighing risks and making careful decisions. But in crowds, behavior shifts. People look to others for cues, and fear multiplies as each action reinforces the next. This herd mentality is especially dangerous in finance. A single viral video of long lines at an ATM can convince millions that banks are unsafe. A sudden drop in stock indexes convinces global investors that they must sell before the crash deepens. Rational analysis is replaced by raw emotion, and emotion is contagious. By the time logic re-enters the picture, the damage has already been done. Technology not only accelerates panic, but also makes it harder to contain. In the past, governments could close banks temporarily, limit withdrawals, or regulate trading to slow the spread of fear. Today, with decentralized finance, global capital flows, and borderless digital transactions, control is slipping away. People can move money across continents in seconds, convert currencies with a click, or shift wealth into digital assets outside government oversight. These tools empower individuals, but they also undermine the ability of institutions to stabilize crises. In 2025, when panic begins, it will spread not only within one country, but across the globe, amplified by the very tools designed to make finance efficient. Another critical element is the role of narratives. Panic thrives on stories, not statistics. A rumor of a bank being insolvent, a whisper about a government preparing for default, or a viral clip of empty supermarket shelves can ignite fear more effectively than any official data. People respond emotionally to stories, and once those stories take hold, no amount of technical explanation can erase them quickly. In past crises, official reassurances were often enough to slow the spread of fear. But in the digital age, where conspiracy theories, rumors, and alternative narratives flourish unchecked, controlling the story is nearly impossible. Panic in 2025 will not just be a financial phenomenon, it will be a battle of narratives fought across every platform. Panic also thrives in environments of inequality. When large segments of the population already feel excluded from prosperity, their willingness to trust the system is diminished. In many countries, the majority of wealth is concentrated in the hands of a few, while ordinary citizens live paycheck to paycheck. For them, the system already feels unfair, and crises are viewed not as natural cycles, but as betrayals. In such an environment, panic erupts more violently, fueled by anger as well as fear. People do not simply rush to protect their money. They also demand accountability, sometimes through protests or political upheaval. The human panic factor thus extends beyond markets, spilling into society and destabilizing political systems. Another dangerous aspect of panic is how quickly it can undermine liquidity. Financial markets depend on the assumption that assets can be bought and sold without disruption. But in times of panic, liquidity vanishes. Buyers disappear, leaving sellers desperate to offload assets at any price. Markets freeze, credit lines collapse, and companies suddenly find themselves unable to raise capital. This breakdown in liquidity spreads across the economy like a contagion, preventing even healthy businesses from functioning. Once again, it is not the numbers themselves, but the human decision to withdraw, sell, or withhold that triggers the collapse. The mathematics of markets crumble under the psychology of fear. The global interconnectedness of 2025 ensures that panic will not remain confined to one nation. A crisis in one market is instantly reflected in others. Investors in Asia react to news from Europe before dawn. American markets open with the weight of global fear already pressing on them. Currency exchanges, bond markets, and commodity prices all move in sync, creating a single massive feedback loop of panic. There is no isolation in the modern world. Panic anywhere becomes panic everywhere, and containment becomes nearly impossible. The most chilling truth about the human panic factor is that it is unpredictable. Economists can model debt ratios, growth rates, and interest trends with precision, but they cannot predict when millions of people will suddenly lose confidence. Fear has no formula, no clear trigger, no measurable limit. It builds quietly in the background until one event, however small, tips it into the open. At that point, the system moves from stability to collapse with breathtaking speed. Markets that took decades to build can crumble in days. Institutions that seemed unshakable can fall overnight. This unpredictability is why the human panic factor is the most dangerous domino of all. It cannot be measured until it is already in motion, and by then it is too late to stop. Every financial crash is followed by devastation, but also by transformation. What looks like destruction in the moment is, in truth, the clearing of an old system to make way for a new one. Yet this process is never smooth, never gentle. It is harsh, unforgiving, and merciless in how it redistributes wealth, power, and opportunity. The coming collapse will be no exception. In 2025, when the storm fully erupts, the world will not simply experience a temporary setback. It will undergo a reset, an enforced restructuring of the global order in which some will be erased while others rise from the wreckage. The harsh reset ahead is not just about economics, it is about politics, society, and the very psychology of humanity in the face of crisis. The first reality of such a reset is wealth transfer. Financial crashes do not destroy wealth equally. They take it from the unprepared and hand it to those who are positioned to benefit. During a collapse, asset prices plummet, currencies devalue, and debts become unmanageable. For the average family, this means the loss of savings, homes, and stability. For the heavily indebted, it means bankruptcy and ruin. But for those with liquidity, with reserves of cash or alternative stores of value, a crash is an opportunity. They buy assets at fractions of their former prices, acquiring control over land, businesses, and resources that once belonged to others. Thus, while the majority suffer loss, a minority consolidates power, widening inequality and setting the stage for a new elite to dominate the post-crash world. The second element of the reset is the reordering of global power. Money and influence are inseparable. And when financial systems break, nations rise or fall in their geopolitical standing. The dollar's supremacy has long underpinned U.S. dominance, but its decline would shift the balance dramatically. Nations less dependent on dollar reserves, while those that have invested in alternative systems, may find themselves newly powerful. China, with its push for yuan-based trade and digital infrastructure, stands to benefit from a collapse in U.S. monetary leadership. Other nations aligned with emerging financial blocs could see their influence grow. At the same time, countries burdened by high debt or reliant on external financing will find themselves weakened, their sovereignty compromised by dependence on creditors or international institutions. The reset will redraw the map of power as surely as any war. Another dimension of the reset is societal. Financial collapse strips away illusions of stability. exposing the fragility of everyday life. Jobs vanish, businesses close, and governments cut back on services. For ordinary people, this means not only economic hardship, but also psychological trauma. When systems they trusted fail, trust in leadership evaporates. This disillusionment often gives rise to social unrest, protests, and even revolutions. Throughout history, collapses have been followed by political upheavals. Regimes topple, ideologies shift, and new movements emerge promising to rebuild society on different principles. In 2025, with social media amplifying anger and frustration, the speed and scale of such upheavals could be unprecedented. The reset will not be confined to numbers on a balance sheet. It will transform the very fabric of societies. The reset also redefines money itself. Crashes force people to reconsider what holds value. In past crises, gold became the refuge, a timeless store of wealth when currencies collapsed. In the future, digital assets, decentralized finance, and central bank digital currencies may play that role. People will seek out alternatives to traditional banking, moving into systems they believe are beyond the reach of manipulation or corruption. This shift will accelerate the evolution of money, creating new forms of exchange and new ways of preserving wealth. The reset will not just redistribute assets, it will rewrite the definition of what assets are. Technology will be both a weapon and a refuge during this reset. Artificial intelligence, blockchain, and automation will not stop the collapse, but they will shape how recovery unfolds. Those with access to advanced technologies will find ways to adapt faster, whether through algorithm-driven investments, digital platforms that bypass traditional finance, or innovations that create new markets out of crisis. At the same time, technology will deepen the divide between those who can harness it and those who cannot. The harsh reset ahead will not simply level the playing field. It will tilt it sharply, rewarding those who control data, platforms, and digital infrastructure while leaving others behind. Another harsh reality of the reset is austerity. Governments weighed down by unpayable debts will be forced to make painful choices. They will cut social programs, reduce subsidies, and raise taxes in desperate attempts to restore balance. These measures will deepen public suffering and fuel anger, but they will also mark the beginning of a new fiscal order. Some nations may default outright, wiping out obligations in a single stroke. Others may restructure, forcing creditors to accept losses. Either way, the outcome will be a brutal recalibration of expectations. Citizens accustomed to a certain standard of living will face decline, while governments once seen as reliable will be forced to admit weakness. The reset will not be gentle. It will demand sacrifice from entire populations. The reset also involves cultural change. Prosperity breeds complacency, but crisis breeds resilience. People who live through collapse emerge with new attitudes toward risk, consumption, and wealth. They become more cautious, more skeptical of promises, more focused on survival than on speculation. Generations scarred by collapse carry these lessons forward, reshaping society's values. In 2025, the coming reset will create such a generational shift. The culture of debt-driven consumption and speculative optimism will be replaced by one of restraint and suspicion. Trust in financial elites will decline, and new cultural narratives will rise, celebrating frugality, community, and independence from fragile systems. The harsh reset will also change institutions. International organizations like the IMF, World Bank, and central banks will face crises of legitimacy. Their inability to prevent or manage collapse will expose their limitations. In the aftermath, either they will be restructured to reflect new realities, or they will be sidelined by emerging alternatives. Regional financial blocs, digital platforms, or new alliances may rise to fill the vacuum. The institutions that survive will not look the same as before. They will be reshaped by necessity, stripped of their old authority, and forced to operate in a world that no longer trusts them blindly. One of the darkest aspects of the reset is how it exposes inequality. Crises do not strike evenly. They hit the vulnerable hardest. The poor, the indebted, the small businesses without reserves, they collapse first. Wealthy individuals and corporations with resources can adapt, hedge, or escape, while the majority suffer. This widening gap breeds resentment, and resentment fuels unrest. In many societies, the reset will not just redistribute wealth, but also ignite conflict between classes. The anger of those who lose everything will not remain silent. It will shape politics, topple governments, and force elites to confront the consequences of decades of imbalance. Yet within this harsh process lies the potential for renewal. Collapses break old systems precisely because they are unsustainable. They clear the ground for new models that might be more resilient, more just, or more efficient. The reset ahead will force humanity to question the foundations of its financial architecture. Should money remain centralized? Should debt continue to drive growth? Should wealth be concentrated in so few hands? These questions will not be answered overnight, but the collapse will demand answers. Out of the ruins, new systems will emerge, forged by necessity and shaped by the lessons of failure. The reset is harsh because it does not ask for permission. It arrives unannounced, sweeps aside illusions, and imposes new realities. It punishes complacency, rewards adaptability, and leaves no one untouched. Families will lose homes, corporations will disappear, governments will fall, currencies will devalue, and entire ways of life will vanish. But in this harshness lies the raw force of change, the brutal mechanism by which history advances. The world of 2025 will not simply endure a crash. It will endure a reset, one that strips away the old order and forces the birth of something entirely new.